Hi, Bilal, you there?
Hello, good evening, everyone, and welcome to Kaplan Professional Middle East and Smart Crowd. Yes, we are shortly starting this because we are just waiting for the time, and as you know, all the guests they join us. We are going to start on time. Welcome everyone, and thank you, Mr. Siddiq Farooq, for joining us. I will go with some introduction and agenda of the webinar today, and I believe we will be talking about, what happened with real estate market in the long term and what is, going to happen in short term. And Mr. Siddiq Farooq, as an expert, in this arena, will be guiding us on various investment opportunities. So just hold on. We will be starting this exactly at 7 p.m. And session agenda will be discussed. Thank you everyone so far for joining. Thank you, Mr. Siddiq, for joining us, and we will shortly start this. And ladies and gentlemen, just before we start, just to double check if audio, video, screen share, everything is clear. Okay, thank you, everyone. Thank you. So, ladies and gentlemen, welcome back again. And thank you so much for joining here for this webinar. And before I formally start this, and because there are a lot of participants who might be joining us, very shortly. So just in the chat box, if all the participants, I would really appreciate if they can just put a line. Definitely, I can see their names, that what is their educational background or in which industry nowadays they are working, so that me and Mr. Siddiq, we should know that what is the background of our participants. So let's say if you are masters, or you have some professional certification, or you are a real estate investor, or you want to develop your portfolio, you might be a banker, you might be an IT professional. So whatever your educational career or working professional, please share, so that we get some exposure, some idea that what is the audience. And meanwhile, other candidates, they can, or even other participants, they can join. Oh, thank you. Thank you, Mr. Ahmed. Oh, that's great, Mr. Sharma. So some tax practitioners are there, and I believe they might be thinking nowadays on VAT and, other stuff, which is right now, happening here in the region. Oh, so welcome, Mr. Nasir, as a charter holder. Thank you so much for joining.
I like this engineer guy.
Yeah, that's good. And my background is, by the way, engineering many years back, when I have not started my ACC or CFA or everything. But
what's interesting, I tell my son or any young person is like, and I don't want to disrespect anyone over here in the financial field, but I tell people, go learn something more technical, finance, accounting, etc. You can learn on your own. You don't need a degree in it. Because at the end of the day, it's all logic, right? So an engineer can easily do what a CFA can do or learn, but it's very difficult for a CFA to go now and learn engineering.
yeah,
right?
exactly.
So not to discredit, I'm a CA myself and a CFA charter holder myself, but I did start my university in engineering, not so much in engineering, but more on the computer science, management information system. So did a lot of Java and C+ early on, and then dropped out and went to accounting, because this was around it was around the tech bubble. There was more jobs in the accounting field than there were in the tech field.
Okay, that's great.
So I just dropped that, and I was just good with math and logic, so I thought accounting should be easy, and I went and pursued my career in that.
Okay. So I believe some of the participants, they have already joined, and other of the participants, they will keep on joining. Ladies and gentlemen, third time I welcome you again and again. And let me start now this real estate funding and investment options, webinar. Let me introduce myself. So I am Bilal Ahmed. I am head of CFA at Kaplan Professional Middle East. My background is from Big Four. I also worked in Island of Mauritius as a senior financial analyst and lead trainer in CFA and ACCA. And before this role in Kaplan as a product leader in CFA, I was the head of equity research in Beckers and Partners, which is an equity brokerage company. So this was my brief introduction and my brief background. Of course, I'm CFA charter holder. I'm also the CMA. I'm also the ACCA and CPA. So this is my brief introduction. I will move on to Mr. Siddiq Farooq. First of all, thank you, Mr. Siddiq Farooq, for sparing your precious time for us and sharing your exposure here in the market. So please introduce yourself, and then we will proceed with the agenda.
Yeah, thanks. It's always difficult to talk about myself, but my name is Siddiq. Professionally, I'm a trained chartered accountant from Canada. I'm a CFA charter holder. I got my CA back in 2009, I believe. Yeah, if I'm not mistaken. I got my charter in when my son born in 2014. So I wrote level 3 twice because the first time I wrote level 3 was the day after my son was born. So it was a tough day. And it was a horrible writing center. Probably the worst writing center. I wrote all 3 levels, all 3 levels, and level 3 the second time, all in 4 different writing centers. And my level 3, the first one that I wrote, was the worst writing center in the world, and that was in Toronto. And I wrote a letter to the CFA telling them not to do that writing center ever again. But in any case, I spent most of my life, started my career with Big Four accounting firms at Deloitte. And as soon as my audit hours were done, I was out of there. And I moved into corporate finance because that's what I'm passionate about: capital markets, corporate finance. I'm a horrible accountant, even though I do have a CA. I do maintain my professional learnings to maintain my letters, but don't ask me to do any accounting. Cash flow is the only thing that makes sense to me. These days, with all the rules and regulations around IFRS and so forth, balance sheets don't make any sense anymore. At least to me, they don't. But I'm a very practical, logical person, and this conversation will very much be highlighting some of the key principles that that you learn as a CFA. I'm sure there's a lot of candidates over here, so we'll try to make it as relatable as possible and more practical to apply those elements. And as we go along in this webinar, you will learn a lot in terms of how I think about things and why I founded the company that I founded, and why real estate, alternative assets in general, is an interesting asset class. And yeah, just like to talk about finance in general. So I'm looking forward to this. Over to you, Bilal.
Thank you so much for the introduction. And ladies and gentlemen, before I start with the agenda and its detail, let me share a few thoughts with you, that because here in this webinar, the people are from diversified background, skills, and professions. So that's why what we will do, rather than just talking about in typical finance terms, we will try to make it very simple. For example, rather than using some technical words like correlation, definitely the finance professionals, they can understand, but we will simply discussing those concepts in a very easy way, so that all the participants, they can get idea that what is the debate here. So ladies and gentlemen, we will talk today definitely about the Kaplan Professional Middle East and crowdfunding company. Then I will definitely ask a few questions from Mr. Siddiq regarding what is direct and indirect real estate investment in the market. Then even we will talk about equity and debt investments in real estate. Then some detailed discussion on crowdfunding, what is the business model and how this wave will continue in the future. Then very important thing here in the region, which is real estate investment trust. And I will be sharing few practical examples of real estate investment trust in the Middle East. And then again, some macroeconomic, variables and how the real estate investment and, all these things, they can be related with the upcoming macroeconomic variables. And at the end, we have Q&A session where if you have any practical questions related with this, webinar, you can ask us, and our expert, Mr. Siddiq, will be responding to those questions. So Mr. Siddiq, starting before the first point, what I have seen as an investment professional in the market, that post World War II, the real estate market, even the companies and then ultimately the investors who were investing, so they have seen a very big growth in their portfolios from 1945 to 1980, and that was mainly due to real estate, especially in US and related countries. Then from 1985 to 2010, it was a moderate return in real estate. And again, especially the region where we are, we have seen a good growth in real estate. So this was the background of real estate as an overall, long-term background. But how you easily differentiate between that, what is a direct investment in the real estate and what is indirect investment in the real estate?
Yeah, sure. So I didn't know I was going to be tested in this webinar, but nonetheless, let me try to answer your question. So direct investment is you investing in a physical asset, a physical real estate asset. So for example, if you bought a house or an apartment and you rent it out, that is as direct as you can get, where you're taking a very active approach in that investment. An indirect investment would be you investing in a fund that takes your money and invest in real estate opportunities. And that could be a public fund, it could be a private fund, where it's sort of a passive approach, where you don't have a direct control or direct access to the asset. It's under through a securitization or a vehicle, like a fund, where you are getting exposure to the underlying asset class, which is real estate. And there's benefits of both direct and indirect, and I'm sure we'll talk about that a bit later. But it all comes down to, in terms of your portfolio construction, how you're thinking about it, and what sort of attributes you want to get exposure to, or so it has its pros and cons, and we can talk about that now a bit later. Bilal, I don't know how you want to take this, but yeah.
Yeah, so it means, in a very, as a common person, what I can understand, that if I am an investor and I am investing in some apartment or some villa or in some office directly, and that might be a huge investment, then that might be direct. Or if I'm giving to someone, and that person or that entity, using their expertise, they pool their funds, and those funds they are investing somewhere. So that is indirect investment. Definitely some fee will be there, but that might be compensated due to enhanced skills and practical exposure by the counterparty. That's fine. And another very important question, and I believe the market participants have interest, because what I noticed as an investment professional, people do invest in stock markets. People do invest in bond market. In stock markets, there is more, volatility, and there is more, volatility of returns. In bond market, people generally assume the returns are relatively stable. For example, if I talk about broader US market from last 114 years, so on average, stock market return was, let's say, 12.8%, especially for large cap entities. But the bond market returns on the same time period was approximately 3% lower, or 4% lower than broader return. So how in the real estate sector, how we can differentiate that? What is the equity mean element of more risk in that investment, and what is the debt investment in real estate sector? How we can slightly differentiate?
Yeah, so this is very interesting, right? Like, I can talk hours about this stuff, right? So I have a very pet peeve around looking at these broader long-term cycles, right? Because if you look at the last 100 years, you said 12% for equities, 3% for fixed income, it's about 7-8% for real estate, right? But if you take out your top 10% of the up days of the stock market, your returns are almost negative, right? So and we as humans don't have the patience to put our money and sit on it for 100 years, right? We are very emotional, irrational investors, and we get in, get out, and we'll talk about this a little bit later. It's not about timing the market, but it's about spending time in the market that ensures you get your returns. But it's all about, like you said, right, understanding what exposure you're getting and volatility of that asset, right? So you might get 12% return in your equity, but you will have lots of sleepless nights because that 12% will do this over that time, whereas your 3% is nice and steady, right? So it all comes down to you don't want to be looking at your Interactive Broker app when you're going to bed and waking up in the morning and seeing a 20-30% haircut in one day. It might recover, but that one day or 1 week, you're going to suffer a lot emotionally, right? So it all comes down to how you do that. And that's not to say that one investment is better than the other, right? And that's also an interesting concept that a lot of people don't grasp, right? Because all these returns are relative to the risk that you're taking and the returns that you're generating from it, right? And all of these instruments have a place in your portfolio, right? It's all about, depends on what's your risk appetite and how much and where you want to allocate in that space. So what was I going to say? Sorry, I lost train of thought over there. When it comes to real estate, it's the same element there, right? So traditionally, if you look at historically, a hard asset, everything is inflationary, right? If you look at equity markets from the beginning to now, they've all been an upward trend, right? Real estate, upward trend. Anything you look at, upward trend, right? Because a lot of that has to do with inflation. That just drives these asset prices up over time, right? All you got to do is you got to manage your timing as to when you're entering, your time horizons, and what are you investing for, right? Going back to, if I go to CFA level 3, I forget the actual, it's over here somewhere, but you're a professional, what do they say, the investment statement that you have to write, right? Your returns, IPS, right? IPS, yeah. So your
professional statement.
Correct, yeah, your return expectations, your risk, and Bilal, you can probably fill in the gaps.
Yeah, exactly.
Because investment is all about managing risk, right? And people don't appreciate that. People think investing is just like, I want to put money somewhere, right? It's not that. It's about managing risk. You manage risk, you'll make a return for buying that risk. And looking at a 12% or 3% return it won't give you any sense of that if you don't understand the risk that you're taking to get that return. So what I mean by that, to bring it down, is if I'm going to take a lot of risk, I should be rewarded for taking that risk. Vis-a-vis, if I'm taking less risk, I should be rewarded less, right? So it all comes down to, okay, how much capital I'm willing to put at risk, right? Because the riskier the capital, right, the more chances of you losing that capital. Hence, you need to be rewarded handsomely to take that risk. And if you have capital that you cannot afford to lose, you would put that in a less risky investment proposition, which obviously gives you more protection and safety of your capital, which means you will make a naturally a lower return. And understanding that relativeness is very, very critical in terms of designing your investment portfolios and so forth. And then based on your own personal needs, stage in life, your requirements, your ability and willingness to take risk, you allocate your capital along that risk matrix, right? So a barometer a lot of people use is risk-free. What is risk-free? US Treasury or a government bond or a fixed income deposit, right? That is as risk-free as you can get, right? Money in the bank giving you money, it's relatively risk-free unless the bank doesn't go under and your money is gone, right? That's relatively risk-free. And if that's giving you 2-3%, then any other investment that comes that is offering you a 5% return or a 10% return, 12% return, you need to understand how much risk are you taking to earn that additional return on your money. And obviously there's lots of different complicated ways of evaluating, measuring that level of risk. In public markets, you look at, standard deviations, et cetera, and so forth. We don't want to get too technical over here, but it's important to understand that risk reward, and you have to look at everything in relativeness and not in absolute terms.
Okay, so in a very, again, simple way, what I got from your point, for example, if I do invest in the stock market, so there is a word volatility. It means sometimes my return is very high, sometimes my return is very low. And let's say my average return is 10% in the stock market, and my risk was, let's say, 15%. So my return is 10%, my risk is 15%. So what I got from your point, that when we go in real estate, whose volatility is less, so it means my return might be, rather than 10%, it might be 6 or 7%, but the volatility will not be even closer to 15%. It might be very less. So it means based on risk-adjusted return, I'm getting benefit. Is that?
So 100%, right? So if I simplify it further, right? So what you're trying to do, what you're trying to explain there, Bilal, is a return per unit of risk, right? Right. So what you just described, return over your volatility, etc., is essentially the Sharpe ratio.
Yeah, Sharpe
right?
ratio.
And sorry again for non-CFA people over here, we're not trying to show off our knowledge of the material, but the simple way to look at it is, for every unit of risk that you're putting or you're taking, you have to generate a return, right? And an investment that gives you the best ratio of that risk versus reward that I was talking about is an investment that is more sizable. To take your example, if there's two investments, right, both giving a 10% return, but if one has a volatility of a risk component of say 10 versus 20, right? The one that is 10 is better because you're getting one return for 1 unit of risk. So your ratio is 1. Whereas in the other case, it's 0.5. So you're taking additional risk, but you're not generating additional return to justify that. And where it's challenging for an average layman person is to figure out, it's very easy to see what returns people offer, etc. You know, it gets marketed very loosely, but calculating that risk, that volatility is where it becomes very challenging for the normal person, because, you know, that's a lot of statistical elements that come into it to figure out what is that measure of risk, right? But obviously this is where you want to consult with the professionals, etc., to understand that and educate yourself. And you don't have to be a rocket scientist to do that, as long as you can have a good sense and again make it relative to things that you're already aware of and you understand. Right? You know, investing in Bitcoin versus investing in Apple stock versus investing in an apartment in downtown versus putting money in the bank, right? That's level of risk. Bitcoin probably the riskiest because that can go from 60,000 to 20,000 in 1 month, right? Apple stock is probably a little bit less risky than that, but that can also move 4 or 5% in a day, right? Especially in our current volatile environment. Real estate, yes, it can go up and down, but not in a short period of time. There's real estate cycles, and money in the bank is money in the bank, right? So obviously, as you go to that spectrum, your return profile will be different for each of those measures of risk. Hope that makes sense.
Yeah,
I'd love to see your comments and feedback if you have any questions on these things.
Yeah. So I got very interesting question, and I believe that is purely related with finance side. But Mr. Taqir have a question that please enlighten us something regarding asset liability relation to risk. So I believe the question background is, let's say, asset liability relation mean, let's say if I'm a pension fund manager from the Coca-Cola company and I have to pay pension to my employees, which is very long-term liability. So definitely to meet that liability, I have to establish a portfolio which might have equity or fixed income or real estate. And then using those, assets, I will try to match that portfolio. Similarly, insurance companies, banks, all the financial institutions, when they have the liabilities, to meet those liabilities, they establish some assets or some fund to manage that liability. So just to relate with my point, how real estate investment can play an important role in the portfolio to manage those liabilities. Any thoughts, Siddiq? Very, very interesting question, by the way.
It is a very interesting question, right? So like you said, right? It could be a pension fund, it could be an insurance company that have a liability that they have to service, right? And that could be paying out premiums, insurance company, right? There might be a disaster and they have to make sure they have capital to fulfill that. In a pension case, pension liability for their retiring people, right? And you need to have assets that match the timing of that liability when that come, right? So we talk about duration, right? Time period, right? So obviously long-term liabilities have a longer duration period and you need assets to match that duration. Otherwise you're creating duration risk for yourself, because if you're investing in short-term assets for a long-term liability, you will have a lot of mismatch and a lot of duration risk or reinvestment risk and so forth. Real estate is generally a very long-term, steady, boring asset class, right? That because the beauty of the reason you see the real estate in general doing well as part of a portfolio is it provides two kinds of returns, right? It provides an income return from the income it generates through leasing that asset. And the other one is the capital appreciation, right? So that's great for an asset liability type of relationship, because you have income that's coming from that asset that can be reinvested to grow the asset pool. But at the same time, you also have that inflation pressure to increase the price, that it will inflate or grow in capital value to also match your liability in the future. So it's a great asset from that perspective. It's a boring asset. It's a slow and steady asset. You don't get rich overnight, right? But it helps accumulate wealth over time.
I believe because its volatility is low, so it's better to keep real estate in the portfolio to manage long-term liabilities. I will come to the other points a bit later, which is actually the agenda of this discussion. But before that, I would like to discuss few points. For example, because I'm also a CCA member, and recently I attended CFA Society Emirates event. And just to share with all the participants, it's a beauty of the market that two analysts, they are in the same room, but they have different opinions about the market. So I want to relate actually crowdfunding, REITs, and other options. But before that, I just need few thoughts. For example, I am thinking that nowadays inflation is very high. So there are many reasons why inflation is high worldwide. So for example, after 1985, we have seen the big wave of inflation in the market. So what I was thinking 6 months or 8 months back, that why the price level, so again, for non-finance people, inflation simply means the things are becoming expensive. The price level is going higher and higher for a basket of things. So one reason, what I was thinking, that inflation is higher because there are problems in the supply side. So this was my strong belief during COVID time, that just like in 1970s, due to oil shock, the supply is low. And due to that, we typically say in the finance world, it's stagflation. So the supply is low, and that's why inflation is higher. But recently I attended a webinar, and I was very happy when I noticed that few people are saying that nowadays it's not stagflation, it's due to demand pull. So do you believe, Mr. Siddique, and then I will come to my point, that we are expecting high inflation? Is it due to supply side distortions due to political and other macroeconomic reasons? Or is it because people saved money during COVID, they were not spending, and after COVID, they got confidence, they are throwing their money in the market, and due to that high demand, there is a high inflation? Any thoughts on this before I start with this?
Tons of thoughts on this, right? So give you some background, right? In university, I hardly went to class, right? But I went to class, my micro and macroeconomics. And the entire time I'll be in class, I would be arguing with the professor, right? Because all these theories, principles, they all say the same thing, right? If everything else stays constant, right? But nothing in the world is constant,
yeah,
right?
exactly.
So it's not a linear situation, right? The way you're talking about it is you're almost looking at a single factor element, right? But the world is a lot more complex. There's multi-factor elements to this, and nothing is linear. So yes, it's a part of supply, it's a part of demand, right? It's a part of velocity of money in the system. It's a matter of the monetary and fiscal policy all being excessively accommodating for an unprecedented time, right? You had interest rates near zero. You had the governments throwing money at people, not through your typical reserve banking element, but actually giving people money in their hand, right? In the US, the government mailed out checks to people, right? And inherently, we as people are consumption-driven maniacs, right? We have money, we want to spend the money, right? So that, I think, in reality caused a lot of this, and is inevitable, right? Because this free money or this cheap money has been around the system for a very long time. And if you study history of all of this, that's been the case for many fiat currencies in that situation, where at some point in time it does become quite inflationary and so forth. There's obviously lots of other components.
Yeah, okay. So before I go again to my main point, because generally people say in the market that real estate is a good hedge for inflation. So it means if inflation is, let's say, 7 or 8% in UAE, so do you think the real estate will compensate to the investors for that inflation?
Yeah, so real estate, hard assets are generally good hedge of inflation, right? You can throw gold in there, you can throw other commodities in there, right? And it's also a function of what currency you're looking at and so forth, right? Again, it's not constant, right? Real estate in a depreciating currency value might not be a great hedge for inflation, because of the purchasing power of that currency in particular. But generally speaking, yes, hard assets like real estate typically do well as over a long period of time, right? You can't, again, look at it from a short specific period of time. Over a long period of time, it does provide a good hedge, right? Because you just need more money, more dollars to buy the same asset in the future. Yeah.
Okay, so now the most, I believe I will be more interested. For example, what I'm thinking as a working professional, and the audience want to know this. For example, if I am a real estate company and there are many investors in the market, so I might be a public listed company like Emaar Properties or DAMAC or some real estate operating companies, right? Or I might be real estate investment trust. I will give you the idea to all the participants. What is that? What is this idea of crowdfunding and how this practically business model works? So please discuss this.
Yeah, so obviously I founded a company called Smart Crowd, right? And we offer real estate crowdfunding. And before we go into that, it's important to understand the premise behind it in terms of why we're doing what we're doing, right? The whole idea around this is the importance of allowing people to have real estate in their portfolio. The challenge with real estate is it's a very chunky investment, meaning it requires a lot of capital for someone to invest in that asset, because generally real estate costs a lot of money, right? Even the cheapest of apartment will cost you 200,000-300,000 dirhams, right? That's a significant amount of money. And there's importance of having real estate in one's portfolio for all the things that Bilal said earlier. It's a less volatile asset. It provides regular income and capital appreciation. So it lowers the risk, right? Volatility is a measure of risk. So it lowers the risk of your overall portfolio, provides your regular income in your portfolio. So it allows you to generate a better risk-adjusted return on your overall portfolio. This is typically how the wealthy are able to preserve and accumulate capital because they have significant amount of money tied up in alternative assets like real estate that generates regular income, allowing them to take risks on other part of capital to really grow their wealth. An average person does not have that ability because real estate requires a lot of capital, right? So if you have, say you're fortunate enough to have $500,000 of investable capital, if you go buy real estate, you're going to have a chunk of your capital tied up in one asset, right? So you'll have concentration risk, right? Leaving very little money for you to put that money to other asset classes, etc., and not construct a very well-balanced investment portfolio. And hence, most of the world's real estate is in the hands of a small percentage of the world population who can really afford it, right? So we wanted to solve that problem, right? We wanted to give people ability, so regardless of how much capital you have, even $50,000, $100,000 of investable capital, that you can get allocation to real estate, direct real estate in particular, right? Because it has its benefits in the overall investment portfolio. And crowdfunding is a solution for that, because what crowdfunding essentially is, as it says, it's the crowd coming together, right? Pooling their money together and purchasing or investing in a particular opportunity. So think about it, that there's a $1 million dirham apartment in Marina that you would like to invest in, but you don't have $1 million dirhams, and you don't want to go borrow $1 million dirhams to invest in that. But you have 100,000 dirhams, so you can contribute 100,000 dirhams and become a 10% owner of that particular property. You might get 9 other people to put 100,000 dirhams, and collectively those 10 people, the crowd, will invest in that property and own that property, and any returns that are generated from that property are distributed in proportionally to those 10 investors. Because what that is doing is that is giving your 100,000 dirhams the same purchasing power of $1 million dirhams, right? Okay. And if you get 1,000 people, then all of a sudden that 100,000 has a purchasing power of a lot more. So it allows you to manage or construct your portfolio in a better manner by introducing this alternative asset class into your portfolio that otherwise you would not have access to.
So it means my key understanding from your discussion is that if I do not have million dirham or $500,000 dirham to invest in the real estate, because I want to include real estate in my portfolio, I might be investing in stocks and bonds, but I want to include real estate. But generally we say real estate is not liquid. It's not quickly convertible into cash. But when I will go with crowdfunding, it means I am going into a liquid investment. And second thing, I am getting inflation hedge. And the third thing, I'm getting the expertise or expert people who are actually investing in the market, right?
Yes. So there's different elements to it. Sorry to cut you off, Bilal, before you move on to your other question, right? So it's important to understand, right? So yes, it solves the problem of not having sufficient capital to get on the property ladder, right? But even if you have money, right? Say you have, you're doing well, you're an investment banker, you got a nice bonus, and you have million dirhams, right? Now, you can take that million dirhams and go buy one apartment, right? And God forbid that building catches fire, etc., and so forth, or that's a bad building or bad developer, and it's a good poor quality. You have a million dirhams sitting in one. You put all your eggs in one basket, or you can use crowdfunding, and you can take that million dirhams and put 100,000 in 10 different properties, right? Again, you're diversifying your exposure in that asset class, giving you a better chance of getting better returns from a risk-adjusted basis. You don't have money sitting in one asset. You have, so that's the other benefit that it provides, right? Crowdfunding platforms, again, then it becomes a matter of how the crowdfunding platform operate, etc. The other challenge a lot of people have is the ability to source deals, right? Not everybody has the time and effort to pick up the phone, talk to brokers, go see, understand the market dynamics, etc., and so forth. So certain crowdfunding platforms will do all that hard work for you, right? So we at SmartCrowd, we do a very sophisticated process of vetting the properties that come onto the platform.
Yeah. Mr. Siddiq, I have related to this point. I'm really sorry. I'm just stopping you. But related to this point, I have a very interesting question, or two actually interesting questions from the participants. The one is by Mr. Haris Naseem, that what if the SmartCrowd, let's say, or any type of this company goes in bankruptcy, then what will happen with their investments, number one? And the second question is about their exit strategy. So is there any lockout period? So please highlight these two questions.
Sure. So I'll address both of them, right? So to address the question around what happens if the crowdfunding is no longer a going concern, right? So you have to answer that. First, you have to understand how the crowdfunding mechanism works, right? So essentially, what we do is we securitize the asset. And what I mean by securitize the asset is we create a vehicle, a SPV, a special purpose vehicle that owns the property, right? So the title deed will be registered to this vehicle, and the crowd that comes and invests will become shareholders in that SPV. So that structure is completely ring-fenced away from the crowdfunding platform. So if the crowdfunding platform is not operational anymore, it has zero impact on your investment because that's sitting in a separate vehicle altogether. But then you have to do your homework to understand whether the crowdfunding platform also has investments in there and so forth. Typically, for a crowdfunding, they wouldn't have any exposure, any ownership rights. They will only have administration rights to administer that. If that platform is no longer in business, another administrator can be assigned to manage that asset. So to answer your question is, it doesn't impact your investment in any way, the underlying asset, right? You still have ownership in it, etc. And we can talk about specifically Dubai as to how that is protected and so forth and how we do it, right? So all our SPVs are set up in the DIFC under English common law, right? You as the investor is registered, it's public information. You can go Google DIFC public register, put the SPV name, and you'll see yourself on the share register. The same information is registered with the land department. You go register the SPV with the land department, you give them the register, share register. The land department knows exactly who the shareholders are of this entity, and this entity owns the property. So even if SmartCrowd is no longer around tomorrow, the DIFC and the land department, which are two public entities, both have information of Mr. Haris Naseem's ownership in a particular SPV that owns a particular asset. From an exit point of view, we, on our platform, we have two exit scenarios, right? Okay. One is a collective exit of the entire property, and that is a decision held by the crowd, right? We typically have a mandatory voting mechanism at the 5th year anniversary. But given the market condition, etc., that vote can be called earlier, and we have done exits prior to 5 years. But it's a decision by the investors. We put the case forward because we might have gotten offers. The investors decide. It's a simple majority. There's governance put into place. I can go into more details later on that. If the investors decide they want to liquidate, we liquidate the asset and the capital is returned along with any capital appreciation to the investors. That's one exit, and we have done 4 exits already on our platform. The second form of exit is secondary, right? So I have a share in a particular asset. I want to offload it. I would come on the platform, list it, and other investors on the platform can purchase those shares from me. So that is a secondary offering as well too, and that is also another exit scenario on the platform.
Okay, thank you so much. So Mr. Haris and Mr. Taqir, he also have a same question. So I believe these 2 exit options, this is actually the same answer, and there was a very interesting question. Just to relate it, what I got my understanding that, thank you for your questions, by the way. What I got, so it means you as a company, you created a special purpose vehicle, and the special purpose vehicle is owned by, let's say, Mr. Taqir or Mr. Haris. And even in the case of bankruptcy of the issuer company, it's a bankruptcy remote vehicle, right? So
correct.
Yeah, okay, that's fine. And the
complete ring fence, yeah.
So it means, because my next point is, I will keep it very simple, that is real estate investment trust. So because there is some public information, for example, let me take the example of Emirates REIT, real estate investment trust. So as per my knowledge, the real estate investment trust simply mean that it's the same thing, but I want to check what is the difference between crowdfunding and real estate investment trust. So in real estate investment trust, let's say its dollar value is 0.24 today. So today exactly $0.24 per unit is the value. And what I noticed for many years, this value is not deviating because it's a real estate. And they also invest in income producing, properties and, the rental paying properties, and even they show those properties. So what is the one key difference between crowdfunding and between real estate investment trust? Because real estate investment trust is also a public security, and anytime I can sell in the market. So what is the main difference in terms of benefits or drawbacks?
So there are many differences, and one difference you just mentioned, right? You said REIT is a public equity, right? Yeah. What we offer on a crowdfunding is real asset, direct asset, right? Yeah. So the key difference over here is on a crowdfunding platform such as ours, on SmartCrowd, you have full discretion on where you are allocating your capital. So you come onto our marketplace, you decide, I want to invest 50,000 in this particular apartment in Marina. I want to invest 20,000 in this particular apartment, etc. So you construct your own portfolio and you have direct ownership in a direct asset, which is not publicly traded. It's not very volatile, etc. A REIT, for starters, there could be private and public REITs, right? A REIT is a fund, right? You're giving money to a fund manager to invest on your behalf. You're relying on their expertise, on their decision-making power, right? So now you're introducing different kinds of risk. In crowdfunding, what we offer you real estate risk. You're investing in a specific asset and you're taking real estate exposure. You come into a REIT, you are taking operational risk of that fund manager. They will have leverage on that. You'll be taking finance risk or interest rate risk, in addition to the underlying asset of the real estate. Yes, a public REIT, in theory, is more liquid because it's publicly traded, right? But that depends on the liquidity, the float of it, and that comes at a price. You mentioned that the REIT has been trading at 24 cents for the longest time, right?
Okay.
Right.
Okay.
That's the current market price of that REIT. But the REIT, their net asset value, meaning the actual physical assets that they're holding, that they have invested in, the net asset value, which is the value of the asset minus any liabilities they have, etc., is multiples of 24 cents. So it's trading at a massive discount. And it's been trading at a massive discount for the last 6 years, right? And that is because liquidity and all this comes at a risk, because the management has been poor in terms of managing the assets, the returns have been poor, etc. So people have less confidence in that ability, hence it trades at a massive discount to what the actual underlying value of the asset is. And that's the risk that you have with REITs, right? And you're also getting public market exposure. So if the stock market crashes tomorrow, REITs will get washed with them more likely, right? Maybe at a different level to what other public equities might do. But it's an equity exposure, whereas crowdfunding in our fashion is giving you a direct exposure.
So you are talking about that when I completed my CFA charter back in 2008, and I was knocking the door of the stock market and the time was bad. And trust me, I invested in some real estate, operating companies, okay, which were in the stock market. So because the stock market was crashing by that time, so even the real estate investment trust or real estate operating companies, they were also crashing. And I was surprised that I studied real estate is here for diversification, but that diversification is not working in this bad situation. So correlation is not a good friend in the bad situation. So that's the benefit of crowdfunding, right?
So, diversification gets misused a lot, right?
Yeah.
So, and it's very important to understand, there's different kinds of diversification, right? There's diversification within an asset class, and there's diversification across asset classes. So let me explain what I mean by that, right? So let's talk about transportation, right?
Yeah.
You can have a fast car, you can have a slow car, you can have a bicycle, you can have a motorcycle, right? You can have rollerblades, skates, a scooter. That is all road transportation. So, okay, fine. You might have 5 different kinds of those. So you're diversified in terms of, hey, if I want to go just to my Bakala down the street, I can go on my scooter. If I want to go across from Abu Dhabi to Dubai, I'll go in my fast car, right? If I want to go camping, I'll take my Jeep, right? So you have different means of road transportation. So you're diversified from that. But guess what happens if tomorrow there's no more, for some reason, all the roads are broken, you cannot drive on the road anymore, right?
Yeah, got it.
You can't go anywhere unless you have a helicopter or or a boat, right? So that's a different mode of transportation, right? Okay. So that's what I mean by a different asset class, right? So you can have what you said, 2008, you got a charter holder, you started investing in equities, and you thought if I invest in real estate equity, I will get that diversification. But no, you were exposed to the equity markets and you were diversified within the equity market. So the overall equity market might have gone 30%, but the real estate companies might have dropped 10, 15%, for example. So you have that diversification, but you didn't have another asset class such as real estate, physical real estate, or gold, etc., because that's where you get the true diversification across different asset classes. I hope that makes sense. Just trying to give practical example.
Okay, so Mr. Siddique here, I have, because there is a shortage of time and the webinar is really becoming more interesting due to the questions. So this very important question by Mr. Naveed, and that is again related with diversification. So any idea, very quick response, and then I will move on to Mr. Haris' question, that is there any option that this crowdfunding companies or these online applications, they are diversified within real estate, for example, within Marina or JLT or some other areas? Do you think they are going, let's say, beyond the borders? For example, they are going to KSA or UK or US properties. So is this sort of, geographical diversification possible, or is it in the mind?
No, it's very much possible, and it's definitely part of our plans, right? But we have to learn to walk before we can run. UK was part of our plans, but given the macro situation, we decided to hold back on that, and rightly so, right? The currency got crushed. The market is not doing well over there. The real estate have some cracks there now. So, it's all about opportunities. At the moment, this place seems to be the most attractive place to deploy capital. So we're very much focused on this current market. We have a lot of money domestically that's coming onto the platform. We have a lot of foreign investors investing in this market, but future markets are definitely part of our plans. We're looking at KSA, we're looking at Turkey, and a slew of other opportunities.
So geographical diversification is
very much possible.
One very interesting question, and that was the question honestly in my mind again by Mr. Haris, and that is What if, let's say, you or any crowdfunding company, when they create a special purpose vehicle and that vehicle own the properties, so even the original company who created, if they goes out of the situation, still the SPV is there. But what about SPV management? Because they are coming from Smart Crowd. So how that thing will be handled?
So different elements, right? So first thing, if you understand that this is a regulated platform, right?
Okay.
So as a regulated platform, you have regulatory capital, right? So, you know, and part of your regulations, etc., you need to have a proper cessation plan, right? A wind down plan if you are going out of business and so forth. And that's where the regulatory capital comes in as well too. So you have sufficient money to do an orderly wind down of your operations and so forth. So in that scenario, a couple of things would happen, right? One would be investors will have the choice to divest their investment and wind down the SPVs as well too, right? Or Smart Crowd will assign another administrator to manage over the SPVs in their absence, right? And the regulatory capital is there to ensure that, you know, lights are kept on, to ensure that orderly handover and wind down is done. So there's a cessation plan that is in place that gets in action, and that's part of regulations, etc. That's why it's very important when you invest in these sort of things that you understand the regulations behind it, whether they are a regulated platform or not.
Okay, so due to the shortage of time, but again, I have a question. What is the mechanism of which prices are established on your platform? For example, this is again a good question. So please, please.
Sure, yeah.
Mr. Ahmed, good question.
Yeah, so everything that goes onto our platform is supported by third-party data. So we provide third-party market data. And in addition to that, we provide third-party independent market valuations as well too, right? Every time you put an offering onto the platform that is supported by that, when we do the secondary market, we also do a refresh of the independent valuation. And on the back of that, the shares are priced for a particular property. So it's not a judgment call by us. It's all done through third-party verification.
So it's a transparent process, right? So it means I got the answer of this, my last slide on technical side, that real estate operating companies which are listed in the stock market, they are real estate, but they are influenced by, you know, macroeconomic factors, just like the stock market. And, you know, when the market goes down, they also goes down. That's great. Let me, in the last few minutes, ladies and gentlemen, if you have any questions, keep on typing. And meanwhile, let me introduce, we are at Kaplan, and all we are the part of Fortune 500 companies, and you know, we are available across the world. And yes, we do offer ACCA. By the way, my starting journey was ACCA. I was not the part of Kaplan by that time, but using the study material in ACCA and CFA for Kaplan. So CFA, which is again something which is giving you exposure for the investment profession. Then CMA, if your focus is on cost accounting, management accounting, and you want to become the management accountant or budgetary analyst, then CMA might be a good certification. ACCA is very broad. CFA focuses on finance. Oh, that's fine. So you have those books with you still now. Then we have FRM. This is again a course mainly related with risk management side. We have diploma. Nowadays, even, you know, VAT and, you know, the corporate income taxes in the market. So we are running the courses in the VAT and corporate income tax. And of course, CFAB is there. So all these professional certifications are available, and whenever all the participants they need and they have friends, they just do contact with our team, and our team, you know, their discussion will be available here. Anyways, these are the products which are provided by the Kaplan Professional Middle East.
I would not have passed my CFA if I did not have Kaplan Schweizer notes. Right? So anybody who's studying for CFA, highly recommend. Especially if you're if you come from a finance background or accounting background, the Schweizer notes or the Kaplan notes are the best way for you to prep for the CFA. Forget the CFA books. Because it gets to the point and it's fantastic. And I really enjoyed the CFA material. That's why, even though I got my charter like a good decade ago, I still have the CFA.
Okay, thank you for this. And we look forward for all the candidates and participants who want to pursue ACCA, CFA, CMA, or other VAT or corporate income tax and CFAB and FRM, all related courses. We have again few interesting questions. That does investing in Smart Crowd make you, for example, is there any UAE residency, or you know, we get the eligibility? Because let's say if I'm making a big investment in Smart Crowd, I'm eligible for golden or green or some other sort of visa. Is this possible?
Not yet, but it's in the pipeline. So inshallah, we'll be able to you'll be able to qualify all the investments on the platform for residency visa, but nothing in place at the moment. There are conversations with the land department to qualify.
So, Mr. Marwan, have again a very good question that on the platform, could you specify where is the income is coming from, which property? Let's say if you are taking funds and you are investing in different properties, then from which properties you are getting income. So you disclose these sort of things?
Yeah, it's fully transparent. You know exactly where your money is going and how you're making your returns. You have a very detailed dashboard on every single investment that you have, a full dividend history, dividend reports on every single asset, and regular updates on each asset. I would encourage everyone to try it out, smartcrowd.ae, or go onto your app store, smartcrowd.ae. It's free to open up an account, and the minimum investment is only 500 dirhams, right? Try it, see for yourself how it works, etc. As you get comfortable with it, you see money coming in from a return renting perspective, then you can decide if you want to invest more on that.
It means you are giving me the opportunity that on my LinkedIn profile, by investing 500 dirham, I can say, hey, I do invest in real estate market in the UAE. So you are giving me
you can build a portfolio, and then you can say I have a portfolio of X number of properties in Dubai, right?
Okay, that's great. That's great. Again, Mr. Karthik have a very good question. Do banks provide leverage against units held by the investors? So any leverage option is available as it's available in the stock market with typical brokerage companies?
Yeah, so no, we don't provide any leverage. None of our investments are leveraged either. They're all fully equity financed by the investors. The banks at this stage, they don't, crowdfunding is a relatively new concept in the region. So banks are not comfortable to lend against your holdings in shares in SPV that has been crowdfunded, etc. But that might change in the future as the rules and regulations open up. But at this stage, you cannot leverage your investment.
Okay, so Mr. Marwan have a counter question that I don't see where is the income is coming from, and I believe that more information will be reflected on the application.
Yeah, so Marwan, you can, if you have any specific questions regarding if you're already a user of the app, send us an email at info@smartcrowd.ae. A team will be able to guide you. If you're already a user of the platform, you can go to your wallet. The wallet will clearly tell you the dividend for which property it came from. If you go to your dashboard, click on current investments, you'll be able to click on the property and see the dividend history there as well too. So if you have further questions, reach out at info@smartcrowd.ae.
Okay, so you can reach out, you can just contact with them, or otherwise that information is available. Mr. Faisal Raja have an interesting comment.
Don't. Faisal Raja is a friend. I think he's just having some fun with me.
Yeah, okay. So I can understand. So thank you for Mr. Faisal for posting here. And okay, that's great. That's great. So thank you everyone. I believe all the questions are answered. And again, if you have more questions, you can contact with us, and even let me share our details. So again, for these courses, if you, your family members or any friends, if they are interested in ACCA, CFA or related professional courses, then our sales team will be there. So here on the screen, here are the contact details for our program manager, Ms. Dima from Kaplan Professional Middle East. So her mobile number and email address is disclosed. And meanwhile, I have few questions. Okay, thank you so much for the comments. But Mr. Ahmed have a question, and that is, welcome everyone, welcome everyone. Yes, really, it was interesting, and I got a lot of exposure. Special thanks to Mr. Siddiq. And so what range of cash on cash returns are we looking at today? Yes, Ahmed, very good question. So yes, any straight response? Yes, Mr. Siddiq.
Yeah, so on a portfolio-wide basis, on average, it's just above 7%, but it depends on property to property, right? So in certain areas, your cash and cash will be close to 5.5. In certain areas, it'll be closer to 9%. So it varies depending on the type of property, whether it's a studio, 1 bed, 2 bed, furnished, unfurnished, holiday home, etc. And that's the beauty of the platform, right? You don't have to, because Dubai is a very interesting market. Some areas do better than the others. and allows you to invest in different kinds of strategies, whether it's holiday home, long-term rental, furnished apartments, service apartments, etc. So you can build your own portfolio, and we are further expanding into categorization of our assets that we put on the platform, so you have a better understanding as to where your capital is being deployed.
Okay, great. So thank you everyone here in the webinar for joining us and sharing your exposure. And thank you so much, Mr. Siddique, for sharing such a, information with us. And thank you everyone on behalf of, Kaplan Professional Middle East. And on behalf of Smart Crowd, we do appreciate your participation here in the webinar. Again, Ms. Dima have shared her contact details. So, or even her, personal contact details are here as a program manager in different professional certifications. So please do share all the questions in the future if you have, or if you are interested in Smart Crowd, or even if you are interested in professional certifications, we welcome you here through this webinar. Thank you, everyone. And recording will be shared definitely with all the participants, because majority of the participants, they want to get again more exposure, Mr. Siddique, from your side. Thank you, everyone. Stay safe. Good night. Bye-bye.
Bye.
Thank you.